The financial world just caught Nancy Pelosi making a massive, multi-million-dollar bet on a major tech stock, while individual retail investors have been panicking and dumping shares, causing this company to crash 30% from its all-time highs. One of Capitol Hill's most successful portfolios is aggressively buying the dip. The stock is Uber Technologies, and today we are breaking down the exact numbers, the hidden risks, and why the smartest money in the market is quietly moving in.
According to the latest congressional financial disclosures signed on June 23, 2026, Nancy Pelosi's spouse executed a highly strategic options trade late last month. The filing reveals the purchase of 200 call option contracts for Uber with a strike price of $50, expiring on March 19, 2027. The total value of this transaction is reported between $500,000 and $1 million. Now, as a strategic investor, you need to understand why this specific structure matters. Buying a $50 strike call option when Uber is trading in the low 70s means this position is deeply in the money. This isn't a speculative gamble on a highly risky tech startup. This is a high-conviction leveraged bet that gives them a massive safety buffer, while positioning the portfolio to profit heavily as the stock recovers. Historically, these congressional portfolio changes have served as leading indicators for institutional trend reversals. So what numbers are they seeing that the rest of the market is completely missing?
To find the opportunity here, we first have to examine why Uber's stock has performed so poorly over the last few months. After peaking at over $100 per share late last year, the stock fell straight into a bearish trend, underperforming the S&P 500 and the Nasdaq by a wide margin. The primary culprit behind this drop isn't operational failure, it's fear. Wall Street became deeply obsessed with the threat of autonomous vehicles and robotaxis. When autonomous competitors like Waymo expanded and other tech players announced aggressive self-driving vehicle initiatives, an unverified narrative spread across social media. Analysts claim that if car manufacturers launch their own independent driverless ride-hailing networks, Uber's infrastructure of human drivers will become completely obsolete, destroying their business model. This sentiment-driven panic compressed Uber's forward price-to-earnings multiple down to an incredibly cheap 17 to 18 times earnings.
But if we step away from market rumors and analyze Uber's actual SEC filings, a completely different reality emerges. Uber is not dying, it is entering its most profitable operational era in corporate history. In their latest first quarter 2026 earnings report, Uber completely shattered expectations. Total trips across the platform grew 20% year over year to 3.6 billion. Gross bookings jumped 21% to $53.7 billion. More importantly, their operational margins expanded from 10.6% to a staggering 14.6%. This operational leverage allowed non-GAAP earnings per share to skyrocket 44%, hitting 72 cents. Uber is now a certified cash machine, generating $2.25 billion of free cash flow in just 3 months. They use that cash to execute a massive $3 billion share buyback program this quarter alone. Their premium subscription network, Uber One, has officially crossed 50 million active members, and these users now account for more than half of the company's total bookings. This brings us to the core of our investment thesis, and the reason why the autonomous vehicle threat is largely misunderstood. Developing a reliable self-driving car is an engineering challenge, but building a marketplace with 200 million monthly active consumers is an economic challenge. Autonomous vehicle companies can build magnificent cars, but they do not have the user base, the routing algorithms, or the brand trust that Uber has built over a decade. Uber is actively transforming its business model into an open marketplace for autonomous fleets. Major developers like Rivian and Lucid are partnering with Uber because it is significantly cheaper to launch their self-driving fleets on Uber's network than to spend billions of dollars trying to replicate Uber's massive customer base. Uber will collect a highly lucrative transaction fee as a software platform, completely removing the heavy capital expenditures of managing vehicle fleets.
Of course, rational analysis requires looking at what could go wrong. The primary long-term risk is an eventual breakdown in partnerships. If a tech giant manages to deploy a nationwide, completely independent robotaxi network at half of Uber's pricing and explicitly refuses to integrate with their application,
Uber's urban market share would suffer. Additionally, unpredictable regulatory shifts regarding gig economy labor classifications always present a baseline structural risk. However, at less than 18 times forward earnings, the market has already priced in an extreme worst-case scenario. Wall Street's consensus 12-month price target currently sits at $105, implying massive fundamental upside from current levels.